Good evening, traders. It is Friday, September 26th. A real quick market update. And I want to go into a bunch of your questions and comments and bring up some interesting charts, especially in the precious metal space, and cover some trading questions you guys have as well. So it is Friday, end of week. We had this gap down in panic selling, a little bit of panic selling at the open yesterday. Lime green on our 30-minute chart telling us that it was oversold and we're starting to get this bounce. The bounce was off the pink day, the pink moving average, which is also seen on the daily chart, which is the 20-day moving average, which if we take a look at the indices, they have just been bouncing up the 20-day kind of religiously at this point and continuing to do so. Now, overall, I am expecting this market to want to push higher. The trend is up. And as much as the market underneath the hood is slowly weakening, you don't want to go against this trend. When the trend is heading higher, we just want to ride that for as much as we can until it proves otherwise that it has reversed. Now with our SPY and QQQ positions, we had a nice dividend payout in this week. I think QQQ had one as well. We'll take a quick peek here. We had a dividend payment as well, which is a nice little added bonus, bring in a little bit of cash flow into the portfolio. If we take a look at where money was flowing today, overall, across the board into equities, small caps were up the most, but really it was kind of a broad market movement going forward. We did see money move a little bit out of bonds. Bonds traded relatively flat, just sideways, trying to figure out if this is a bear flag and moving down, or if it is going to turn up and start to run higher. Obviously, long term, it is still pretty bearish and not the best looking chart at this point. So not too excited there, although at some point bonds will become an opportunity to the upside. But depending what the administration is going to do and things like that, man, it might still be a very long and painful road to be in the bond market. Now, just a reminder, this 30-minute chart where we see oversold conditions and panic selling and FOMO, where we have short-term highs and lows repeatedly through the week, all of that, just in case you haven't seen this, is in my book, Technical Trading Mastery. You'll see on the new edition on Amazon, it's got a gold bar here. Those indicators, the formulas, how to set them up on your trading platforms is there. I give you the formula. Every platform's a little different, so you just put in the values and you can tweak it, make it look like what I have here, like an area chart with the blue, green lines, all of that stuff. But all that's in this book. Great way to be tuned into the markets and know these overbought, oversold conditions and turning points. It really does take a lot of stress and worry out of the market when you see everyone else stressing but you. It puts you in the driver's seat and in control of your emotions. So with that said, one of you was talking about how they trade the 30-minute chart, or sorry, the 1 hour chart. And they trade the 2 hour and the 4 hour chart. Now, those are typical charting. I just want to touch on this quickly because I think it's kind of important. A lot of people use those. Those are just like standard intraday trading timeframes. But you need to remember they're not equal. They're not really the best tool. I like things to always be balanced. I like things to be efficient and have equal weighting in terms of an hourly candlestick chart. Well, the problem is there's 6.5 hours in a trading day. So one of those hourly bars, depending on your software, however it works, is going to only really have half the value, half the weighting of what it really has. The 30-minute chart allows you to get the 12, the 13 kind of bars that are in the day versus the 1 hour chart. So this is why I use the 30-minute chart. Every bar here has got the same amount of time, and it's not skewed with a close or an opening price that could be out of whack, and it doesn't have the full weighting. Did it really close there for that bar, or is that just the bar ran out of time because it's not, there isn't a full hour for one of those bars. So make sure you always use intervals that allow you to have an equal weight on them going forward. So let's get into some interesting charts. So let's go back to the 2007 time frame. We talked about this the other day. We have the S&P 500. This is on the top left chart, 2007 market high. Stocks put in a high. Gold started to pick up and shoot higher. Just before the last final major push to the upside, gold miners came to life, and we're starting to see that right now. This is on the right hand side here is where we are. Gold's starting to scream higher. Gold miners have now come to life. Everybody's moving into the space for bigger moves, and so that tells me that I think we are on the last month or two of of the precious metal space going higher, and that the stock market could put in a top at any point here over the next month or two. But somebody asked, they want to know, how did silver perform in 2007? So let's just zoom forward a little bit here. If we go to the stock market, sold off 55%, gold pulled back about, well, this doesn't show the wick highs or lows, but about 30%. Gold miners fell 65%. Well, let's see how silver performed. This is one, a couple members actually wanted to see this. So silver, percentage-wise, I just have to go back to the same time frame here. So we go back to 2007, and you can see, here we go. So gold shot higher, continued to run 32%. Even as the stock market sold off, we saw gold and silver move higher. Percentage-wise, silver had a very nice run as well. It had a bigger run of 41%. So again, this is where physical metals can do really well. We talked about how gold miners could move about 18%. The last time they moved 18%, and that's because they're stuck in the stock market. And as we know, when the tide goes down, when the stock market goes down, it's going to mute the gold miners a little bit because they're a stock in the stock market that's going down. That's why you want to go physical and catch the moves to the upside. Now, they also wanted to see what platinum did. Let's take a look at platinum for that time frame. Platinum. And of course, I'll have to go back to that window here. If we go and take a look at what platinum did, platinum, again, shot higher. It got all the attention, or got a bunch of attention here, somewhere around here. We saw a big move in platinum, moved about 50% to the upside before eventually rolling over, and it sold off about 63%. So as you can see, these things are not safe to hold as a long-term defensive safe haven play. They are not a safe haven play. They are a defensive play that when money's flowing out of the stock market initially, money goes there to protect it. But then usually money, exits pretty much all asset classes, and then we see these big corrections. So gold's got quite a good upside potential and a very limited downside. Everything else is usually 50, 60, 70% downside is what we saw in 2007. And it might not drop that much this time, but overall just they're a lot more volatile. But there is potential to squeeze out a bit more percentage in these other ETFs. Now, there's a way to take advantage of this. I've talked about it several times, but maybe not in the last couple of months, is GLTR. This is a symbol here. This is a precious metals basket. And so if we take a look at it, I'll zoom way out so you can see what it's done. It peaked out. So this basket here holds gold, silver, platinum, and palladium. So this gives you the basket of all of them. So you don't really need to focus too much on which one is going to do well. You can just buy this one ETF and you get to play them all. Now it's heavy weighted in gold, and then the second heavy weighting is silver, and then some platinum, and then some palladium. So it's not equal weighted across of them all, but this gives you the whole precious metal space, or the core precious metal space, in one play. And is kind of an interesting play. And I've mentioned this before. It's kind of that really kind of passive, no-brainer type of play if you just want to get into precious metals as a whole, and you can play this during a precious metals type of rally. Another quick question was, Bill, what do we move into when we move to cash? Now, this is an ETF we move into. It looks really funky if you've never seen one of these, but this is just a 3-month treasury bill, meaning it's like a cash position. So if your brokerage doesn't pay you a good interest rate when you're just sitting in cash waiting for a trade, we buy BIL. This ETF here, more or less every day there's interest added to the share price. So you collect daily interest. If you hold it to the end of the month, all of that interest gets paid out in this purple number at the bottom as a dividend payment. So you get this cash dividend payment. And then, of course, the next month it just continues to build interest and then pays it out. And so it's really just, it doesn't matter where you buy it or sell it. If you hold it over time, you either earn interest from the daily growth, or you earn the dividend payments, which is all of the interest just paid out in lump sum cash injections into your brokerage account. So this is an easy way, a safe place to move. When you go to cash, if you don't earn interest with your brokerage account, you come here. And this is what we do with our auto trading investors, because it's a way for us to continue to grow our account while we're waiting for a new trading opportunity. Or when we take partial profits out, we move into this so that our cash is still earning a bit of growth. This is like the 4.5% growth really no downside risk, and we get to just continue to grow our account. And just a quick reminder, I wanted to talk about if you aren't subscribed to this channel and you watch it regularly, just in a bull market, when the trend is up in the market, stock splits are a really unique type of trading opportunity. Post your comments so I know. I remember this with Taser. I don't even know if Taser's still around. I remember when the company Taser came out with
reply to most comments,
police officers and stuff.
If you want access to my trading analysis,
these videos are usually just every time it got to $100 a share, they would do a stock split, cut it in half.
If you actually want my trades, my ETF trades, you can subscribe to Apple here. The technical
and what's interesting about stock splits is simply, if you guys remember, Apple
my own
was
portfolio,
really,
and I share those trades with you. We literally just grow our wealth
so it was
together.
$120 times 4, so it was like $480 a share, and a lot of people can't afford that, and they're like, well, I don't want to buy one share, or I don't want to just buy 3 shares. It feels like I don't own anything. Well, what they do is, if a stock price gets highly valued and say they think or feel it's kind of a management play to keep the share price going up, they're like, instead of having a $500 stock, let's do a 4-to-1 stock split, and we'll just cut it in half, or sorry, cut it into a quarter, right? So you end up with a cheap share price again. So now people go from saying, well, Apple is $500 or $2,000. It was really expensive back then. Instead of a $2,000 share price, you're like, okay, now I've got a $400 share price. I can afford some. And so it opens the doors for more people to buy shares, especially people who have really small accounts who say couldn't afford a $2,000 share. They can afford a $500 share. And the other thing here I want to just touch on is a lot of people say, well, I don't want to buy high-priced ETFs. And I get this all the time with our SPY and our QQQ ETFs that are like $600. They're like, well, it's really expensive. I don't want to buy something that expensive. You're not going to make as much. And this is one thing that people need to understand is it doesn't matter if it's a $500 share and it goes up 1%, or if it's a 1 penny stock and it goes up 1%. It doesn't matter how many shares you have. It's how much money did you put in, and you're going to make that 1%. So you don't ever get thrown off that a share price really means anything, and you don't need to hold more shares to make more money. It's not how that works. It's if the share price goes up 1%, your account goes up 1%. It's that simple. So, but this is the mentality that people have, is they think expensive stocks, they don't want to buy them because they don't get enough shares and they feel like they don't have a big enough position. And so they do a stock split, and of course prices naturally go back to their original level very quickly afterwards. So if you cut the share price in half with a 2-for-1 stock split, usually the price will go back up to its original price. So you can double the stock price with that. And it's a smart move that CEOs and things do with their share price to keep things moving higher for them. And we have a bunch of comments here from members that I want to just touch on as well really quickly. So we've got some comments here this morning. Let's touch on this question here. This person's talking about, well, if the trend is up and prices keep moving higher, why are we locking in profits instead of just moving our stop up and let it keep running? And it makes sense in theory, but the reality is the market doesn't always go straight up. The markets are only trending 25, 30% of the time, and the rest they're chopping around and moving. And so I did share my reply here, and the whole reason, most of the time the market is chopping around. And the way we have our strategy set is usually where price hits its first resistance level is usually our first profit target. And what happens is the question comes down to, do you want a bunch of trades that move up and then you're swinging for the fences because you want to catch a bigger trend? You don't want to lock in profits. You're going to say, I'm just going to let this trend keep going. But what happens is a lot of times that first resistance level gets hit, and then the asset starts to move back, and then it starts to sell off. And so even if you moved your stop to your entry price after your first target has been hit, then when price rolls over, you get out at your entry price. And what happens is you end up with a bunch of trades that don't make any money. They get out at break even. And you got into these trades, and you kind of give back gains. So you have to lock in profits. That's part of managing risk. And all of this is, if you don't, then you end up having a lot of trades that don't make any money. And you have the occasional big trend trade that does well. But it's not a fun way to trade and invest. It's much better to have a whole bunch of trades that make a little bit of money. And then when one does take off, you continue to ride it with the balance of your position scaling out as it goes higher and higher. So that's kind of that mentality. If you always just want to hold out for bigger gains, you're going to end up holding on to stocks that give back the gains, and then you don't get out generally because of our ego and our emotions, and we just don't want to take a loss. And then you ride it down, you end up with positions that turn into from winners to losers. So that's why we take partial profits. That's why we underperform on the way up when the market is rallying, because we're protecting our capital, managing risks. We make it back when the market sells off and we move somewhere else that goes up in value and all of that stuff. But we do need to protect our capital there. One of the members was asking about the Technical Trading Mastery book with the indicators. And a member shared a really good comment here saying that if you have the Kindle version and you bought it a long time ago, you just need to delete it from your device and re-download it, and you'll get the new version with the trading indicators in it. So that is a pretty cool feature there. So WR Marcus is asking about, I still have a bullish outlook for gold to move higher. And he's wondering if gold's still going to go to 4,100, why don't we get into GDX and take advantage of that 9% move? Long story short, and I do share my answer right down here, is I'm providing what I think is the best return with the least amount of risk. I'm trying to protect our capital and still take advantage of these moves. So we're already in PHYS, which is like a physical gold ETF. I think it's got good potential. I think it has potentially more than GDX, as we've seen in my recent updates for this last push, because gold stocks could get stuck in a bit of a sell-off and have some downward pressure. So we're already in the gold play. We've already locked in partial profits, and we're in the middle of the trade. We're already in this. So getting into GDX is like, if you're already in the trade that we're in for gold, then you're kind of just taking more risk. You're jumping in more, which is fine. But I already provide the signals. And if you want to do anything above and beyond, that's up to you. I know people are trading leveraged ETFs. You're trading silver miners or gold miners. Some of you are trading platinum or palladium. You can do whatever you want. I provide the signals for the overall stock indices and metals and things like that, and what I'm doing. And then, of course, you guys can amplify it with whatever other plays you want to do there. And let's take a look what else we have here. So this guy, Really Lucky Dog, came out with some very good comments and thoughts and questions about this morning's update. If you saw it, one of the traders ended up making about $11,000 on the gap trade we talked about yesterday, how the market's going to gap lower and likely to bounce and rally. And it was in the uranium space with CCJ, which is Cameco, I think it is, and Cameco. And anyways, he's asking, well, if this person's got a $20 million account and he's putting $200,000 at stake, which is the average, 1% of your portfolio per position, is this a gamble or is it a trade? And, for him to make that kind of money, he's saying, well, maybe it was 3% or $6 million account. Long story short, just to answer this, when somebody's doing a day trade, typically you're using a lot of leverage. So you're usually using 2 to 4 times leverage, and you don't really follow this. Your trade is 1% of your portfolio. A day trading account, you're usually swinging for the fences with a huge chunk of that particular portfolio at any given time. Some people will be trading 50 or 100% of their portfolio in probably every day trade, depending on how it goes, depending on how they trade. So don't think of this 1% position for the portfolio per position. In fact, I'm not a big fan. That's kind of the old school thinking. The last thing I would want is, our portfolio with the ACS strategy usually has 1, 2, or 3 ETF positions maximum. And one of those could be a cash position like BIL, which really it is and it isn't, a position. It depends how you look at it. This whole theory of 1% of your portfolio in a trade, man, the last thing I want to do is have 97 other positions to manage, right? I want the least amount of stocks and things to trade. So anyways, you can pause this. You can read my reply on it. But the question around this was, how do we know that this guy took a trade versus a gamble this morning doing that day trade on the play? And I would say it comes down to the insight that we had from the morning video saying, hey, listen, the markets are set to gap lower, and they're likely to get bought up. We're still in an uptrend. The market's going to gap lower from just panic selling during that day, the previous session, and overnight trading. And so this person saw uranium moving higher in the morning. Yet this uranium stock was set to gap lower because the stock market was pulling it down. The stock was stuck in the stock market falling tide. And so he sees the divergence, the opportunity that, hey, when the market opens, if the stock market's likely to rally and the commodity and uranium is higher in pre-market, this thing should bounce right back. And that's what he ended up playing. So to me, it was a very savvy trade, very quick. It was definitely a day trade, but this person's in, if there's in tune in the market as I think, it made a perfect sense as a trade to take advantage of. And so to me, the insight was it was right timing. He got the divergence. He played the stock market gap in favor with the CCJ trade itself as well. So in a nutshell, the markets continue to grind their way higher, and we're just letting this market take a bit of a breather. Today, we did see utilities push up fairly nicely, 1.6%, outperforming the stock market yet again. So money's moving into utilities, which is a short-term kind of bearish signal, meaning we should expect the stock market to potentially still trade and chop around a little bit next week. If we look at the SPY, for example, and just kind of zoom into the chart, we could easily see price, ping pong around. It might trade sideways for a little while before potentially running higher. So that's what we just need to be mentally prepared for. But overall, we are bouncing up the 20-day moving average, and we'll just let the underlying trend work itself out going forward. Hopefully everybody has a great weekend. Talk to you soon. Bye-bye.